Thank you so much for joining us on the Dwellynn Show. I'm your host, Ola Dantes. I've got an incredible, legendary guest with us today, Kent Ritter. Hey, Kent, how's it going, man?
Hey, Ola, how are you, man? It's great to see you.
Yeah, lovely to see you. I think we were just talking before we hit recording. Yeah, we met a couple of years ago. So yeah, always nice to kind of just reconnect, kind of see, how far you've come since the last time we talked. So yeah, really looking forward to diving into this.
Yeah, absolutely. I'm looking forward to sharing the story, man.
Let's share the story all the way. So just kind of tell the folks, who you are, kind of what you've been up to lately, actually, and kind of what you do.
Yeah, absolutely. So as Ola said, my name is Kent Ritter, and I syndicate apartment buildings. I focus primarily in the Midwest, and really, I started out my career as a management consultant and spent about 12 years in that line of work, really helping large companies solve big problems. And that was just a great experience on you know how do you make a business successful, but like even more on like what not to do, right? Because like nobody called us when things were going well. So I got to get a lot of examples of things you don't want to do in your business. And I think I carry that forward now as I have my own investing business, and as we're syndicating these apartments. And about 7 years into that career as a management consultant, I left the firm I was at with a few partners to start our own business. We started our own boutique consulting firm. We ran that for 5 years and grew that to about 30 million in revenue with 95 employees, and then decided it was the right time to exit. And that was 2015. Now it's man, it's getting out there, 2021. But that really started my real estate career because I had this capital from the sale of the company. I knew I didn't want to have all my eggs in one basket in the stock market. So I started looking for alternative investments, and wanted to find something that would preserve my capital, but also grow it at the same time. And so as I started researching different things to invest in, real estate just really stuck out for all the benefits that it provides, which is many. And then as I continued to educate myself and found some great mentors that really led me into multifamily, I fell in love with the space. Started out investing passively to really learn the ropes, and then as my knowledge and confidence built up, then I moved to start actively syndicating my own deals in 2019, and the rest is history. We've been rolling since then. So yeah, it's really kind of a second career for me, if you will. I didn't really expect it, but I just found this passion for real estate, and I really enjoy the process. And I love this idea of syndication where I can pool my money together with others, and I can bring everybody else along, and we can all build wealth together. And it's just been a great ride the past year and a half or so since we've been going active full time.
Wow, there's just so many things that you said that I definitely want to touch on. So you worked in I'm guessing one of the big fours as a management consultant. You kind of learned, how businesses work, how you could scale businesses, and then you left, did your own thing, did really well, then exited. So I want to kind of break those down a little bit into digestible
Sure.
chunks, I guess. So how did you guys grow that business, though? I mean, it's not a joke just to to grow a business to 95 employees over that span of time. So how did you guys do that? So that's number one question. And then why
Yeah.
exit? Why exit if you guys were crushing it?
Well, that's an easy answer. We got an offer we couldn't refuse, right? So but I'll start at the beginning. So the way that we grew it was, well, one, and I took this for granted at the time, was we had a great partnership, a really strong partnership, and everybody had complementary skills. Everybody was able to own their own swim lanes, and because of that, we were able to grow very rapidly, because everybody was strong enough to kind of stand on their own and own their own piece of it. And we all just got along. We were all friends. We're all still friends today, even though we're out doing different ventures now. But that partnership, I mean, was critical. And I really did take for granted at the time, like how rare that can be to just have such a strong partnership. Right. So then, so some of it, and then some of it, I mean, I can't say it was all us. I mean, we hit the market at the exact right time. So really what we were, the reason that we left the firm that we were at was because we were down in the trenches. We saw the market taking a right turn, and we saw the direction of our company continuing to go straight, right, and continuing to kind of continue to do the old way. And we said, hey, this old way is not going to work, because the way that technology is advancing, everybody's turning right. So if we don't turn right, like, we're going to get left behind. So we essentially left, and to focus on these new technologies that we're developing and get really good at helping companies implement them. We didn't actually do the implementation, but we did we were like the kind of the CFO and the CIO's like right hand as they go through these major implementations, to make sure that they were making they were preparing financially and also for the organizational change that needed to happen. So we got really good at this, and we were able to just rinse and repeat this model. And in creating those systems, we're able to scale so quickly. I think the success was we really niched down into a specific thing. We got really good at that, and we just rinsed and repeated it. And we caught the market at the time where the technology was just exploding and extremely relevant. So there was we caught that growth curve. And I think that's what allowed us, the good partnership and the things that we did, but also, you can't knock market timing. And that really helped us grow. And then we got to the point where, there's a sweet spot with companies, right? Where, if you're too small, you can't get a good enough valuation because you really don't have the track record and kind of infrastructure there, right, to really plug into a larger business. And if you get too big, then the buyer pool really decreases, because there's only so many companies that can pay that much, right? So we were kind of right in that sweet spot from a size standpoint. And we were just offered a multiple on our business that was, about 2 times what you would typically get for a professional services firm, because we had that technology tilt to what we were doing. So, we got an offer we couldn't refuse. Honestly, we got an offer that was more than we ever expected. And it made us really question, like, we started getting unsolicited offers, and that really made us say, wow, should we consider exiting? And we went down that path, and we went through a marketing process just like you would with an apartment building. And it just made sense. It made sense for everybody. It made sense for where all the partners wanted to be. Many of us had grown families at the same time as we were growing the business. And in the business that we were in, you're on the road all the time, constantly traveling. So there was kind of a desire for better work-life balance. And like I said, just you shouldn't turn down those great offers. Those don't come along, so many times in your life. So we took advantage of it.
Man, that is such an amazing story. My master's degree is actually in strategic marketing and consulting. So, most of my, my friends from my master's degree, I've gone on to work for Accenture, PwC,
Yeah.
KPMG. Yeah, so yeah, that was the path I was supposed to go on, but I took a different turn. So it's just absolutely fascinating. I still have my friend, she works at Accenture, and she's in India today, and she's in another country on Facebook. So it's actually,
I still have a lot of those friends too, man. I got a lot of those friends. A lot of them are invested in my deals now.
Yeah.
And asking, man, like, what are you doing? Because when you leave when you leave a job that is, mid to higher 6 figures, depending on the year and the bonuses, people look at you and say, what the hell are you doing? Like, why are you walking away? Because the way it works, like when you sell a company, you don't just get to like walk away. Like you have an earn out where like they want you to like provide value now that they've bought you, right? So you have a time period where you're working there, and all those people that thought I was crazy now are coming back, and a lot of them are investing in our deals, and it's great to see. But what I'll tell you is you absolutely made the right choice. I mean, what I would tell myself if I could start all over again was quit screwing around with the consulting, just start buying real estate.
I love it.
I had started that when I was 22.
Yeah.
God, I'd be 100 times farther than I am now.
Right, I know. If I read the Rich Dad Poor Dad book when I was 19, yeah, I would be, I would probably,
Exactly.
yeah. But anyway,
Exactly.
I want us to kind of pivot to real estate. So love that story up until the point. So when did you actually started buying real estate? What was your first deal? How did you find that deal, and how did you fund that deal?
Yeah. So my first deal, like my first foray into real estate, was actually on the debt side, doing private lending and building up a note portfolio. So I was selling houses on contract and creating that a portfolio of mortgages essentially, right, or notes. And so I was owning the debt on these houses, and you know I had, because that was like a family friend was doing that strategy, and so that was kind of, I just got onto them. They taught me and I started doing it. Well, I one day, not long, probably like 6 months in, um, one of the houses that I owned the debt on sold, and I get the HUD statement because I'm the lender, right? And the house had doubled in value, and that person had, they bought it for 70 and like sold it for 140. And I was like, oh my gosh, like, look at this. This is crazy. And all I'm doing is getting my loan paid back. I'm like, this guy is making a killing. I was like, all right, I have to start buying assets. Like I need to be on the other side of this. So that's really what set me, like, continued to set me on the right path. And in that time, I was continuing to research, kind of realizing that multifamily really was going to be the best strategy to scale to the level I wanted to, because I started doing the math on single families, because like you know what you're exposed to, right? And the only, like, I knew a guy that was doing this debt strategy, and all the other people I knew that were in real estate were like, they owned a couple single families and they were their own landlords, right? So like that's what I thought investing in real estate was. So as I started to educate myself, you learn about multifamily, and you're like, man, this is the way to go, because this is the only way to scale to like get to where I want to be financially. And so I started out passively investing with others, because I recognized that there was a lot that I didn't know. I mean, I was new to real estate at the time, and there was a lot that I probably didn't even know I didn't know, right? So I wanted to continue to learn. So I invested in 10 deals in 2016 passively.
Did you say 10?
10. Yeah. So I spread
Wow.
my, spread capital across 10 different deals. And I did that because I wanted to have exposure to different sponsors, different geographies. I wanted to get a feel for how people operated. And I knew that, different sponsors had different styles, and I wanted to see what I liked and what I didn't like, so I was able to take that experience, and the learning from all that. And I'm sure I was a pretty annoying passive investor, because I asked a lot of questions, right? Because I was like, why are you doing this type of debt? Why are you doing this? Why are you doing that? Right? Because I wanted to learn, because I always had this vision that I wanted to do it on my own. I just felt like I needed to build up my education before I took on other people's money. I mean, I took that very seriously. So I did that. And so from 16 to 19, that's really what I was doing, additional passive investments. So I was doing some other stuff on the side, some other real estate things, but really mainly passive investing, using that to learn, going to conferences, listening to podcasts, reading books, and doing a couple of mentorship programs. And I got to the point where I was like, man, the stuff I'm hearing at these conferences, like, I already know. The stuff I'm hearing the syndicators say, like, it all makes sense to me. I can see the strategies that work and don't work. And so I got to the point where I had the confidence to say, I can do this on my own. I know I can do this well. I know my consulting background prepares me to manage change and manage projects and really do what's required to make a syndication successful and communicate well along the way, which is like the center of everything. So that was really how I moved into actively syndicating deals.
Awesome. I really love that. So you had all these kind of deals going on, kind of the 10 deals, which I think is absolutely fascinating. And then you were like, I'm ready to go do my own thing. So when you made
Yep.
that decision, what was your main strategy? Because now you've got all these tactics, right, from different
Yeah.
syndicators. You were doing your own self learning. But what was your kind of trick to make that jump from just being on the LP side to becoming a GP?
Yeah, I mean, really, the trick was again good partnership. So I had Through that time, right, I had built a lot of relationships with different sponsors. I'd been doing a ton of networking, going to probably 10, 12 real estate conferences a year, just trying to build my network and meet people. And I met some folks that I really resonated with, right? I felt like we thought the same way. We were going after the same type of real estate, wanted to follow the same model. All these things just kind of just fit. So, and they were a little farther down the path than me. They, especially a couple of the guys had done, I think 2 syndications at that point. So they had some experience under their belt. So we decided to partner together on a deal. And again, I was able to continue learning, right? But now I'm not, I wouldn't say I was in the driver's seat, but I'm sitting shotgun, right? So we're there, we're making, I'm helping with asset management and underwriting, making decisions and raising capital and investor relations, and kind of getting that experience in my first deal. And so really, yeah, the secret was just, again, another great partnership that got me to that next level. And then it just, yeah, it kind of continues from there.
All right, yeah, let's do it. Let's jump into a case study. So, what was the very first deal that you were an actual GP? Kind of walk me through that process. How did you guys, find the deal in terms of like deal sourcing? How did you guys, raise the equity? How's the deal going right now?
Yeah. So the first deal, it was in Atlanta, Georgia. It was actually just northeast suburbs of Atlanta, and we found the deal through a broker relationship of one of the partners who was down there local, and had the broker relationship through a previous purchase, and so it was a kind of a off market or kind of pre market deal, right? Wasn't widely marketed. We were able to come in and we were able to purchase a portfolio. So we bought 2 properties at 250 units total. It was a 100-unit building and 150-unit building, about 20 minutes or so from each other. And both kind of what we were looking for, Class B properties. One was built in the 80s, mid 80s. One was built in the early 2000s. So fairly new product from a multifamily standpoint. And just in great markets with really high growth and high median incomes. And that's one of the things that you want to look for when you're looking for apartments. I mean, depending on your strategy, but these apartments really would be marketed to kind of entry level white collar jobs. If you, it's kind of how I would describe it. And so we felt like that was a really good demographic, a really strong place to be. And we were able to get a fairly good deal on the properties. And so that was 2009, 19. As we know from there, what we did was we came in and we did what I call kind of a light value add. So we improved the interiors. We improved a little bit of the exterior, but the exteriors weren't bad because they're fairly new. There wasn't a lot of deferred maintenance. So we're really able to focus on the interiors, really modernizing, improving the management, improving the marketing. And through that, we've been able to, raise rents considerably. We've been able to increase our NOIs. I mean, on one property, we've had about a 30% NOI increase. On the other property, about a 20% NOI increase. And actually now we've actually decided to again, we took it to market. We got great offers and we decided to exit the properties early, ahead of the business plan. The hold period is going to be 5 years. We're going to sell right about 2 years, just because of the value that we've already created. We can hit our returns that we promised the investors in just a truncated timeline. So again, it's like you get a deal you get an offer you can't refuse. Don't look a gift horse in the mouth. Take it, chalk up the win, and move on.
How was the equity raising for you guys? I think, for those listening to this, people that listen to podcasts are, for the most part, people that are trying to start, right, in this game. Yeah. It's not, the big guys, So for someone trying to do this and trying to figure out how to raise equity, how did you guys go about doing that? What are your tips and tricks because I'm guessing this is probably a 250-unit deal in Atlanta, Georgia, 80s vintage, probably it's somewhere between 80 to maybe 120K a door. So this is a big deal, right? So the equity.
We needed to raise about $8 million for the deal. And we split that up between kind of four 4 groups of partners, if you will, and distributed that. And, we had, and so we just split it up and we went out and started raising. And some of the, a couple of the partners, like I said, were farther down the line. They had larger networks than me, so they had bigger chunks and they brought that money in. I was really just starting, right, to raise my own money. And so it was, again, a great learning experience. I'd say I didn't meet the goal of how much I thought that I could raise, to be honest. And what I underestimated was the need to change people's perspective of who you are. So people didn't view me as a real estate expert, right? People viewed me as a high school buddy or a college buddy or a fraternity brother or a consulting coworker or a consultant or
This is
as a
so
client.
good.
Right.
Yeah, this is
Right.
so
They
good.
viewed me in all these different ways. None of those were real estate professional. Right. And so what I underestimated was the need to do the work up front to really put out the thought leadership and talk to people about what I'm doing and explain the process and kind of warm people up to this idea before you come and say, hey, got this great deal, you should invest in it. Right. So I think, looking back, I should have started 6 months ahead of time, year ahead of time, just as soon as I knew, just talking to people about what it starts with, just talking about what you're doing. Because the more you talk about it, the more people hear it, the more they're going to start to associate you with that. And then once you actually start to have some success, you'll really see the tables start to flip. Because, at the beginning, I got a lot of, well, let's see how it goes. Maybe I'll be in on your next one type of thing, right? Now that I've had some success, now that we're on deal really 5, it's, hey, tell me more about what you're doing again. Hey, can I get on? So, you start to have kind of this wave of people start to come in as you build track record. But that was really the thing. And, so I underestimated that. Because of that, I wasn't able to meet the goal of how much I wanted to raise. I mean, I raised a decent amount, but it wasn't what I wanted to achieve. But that, again, like with everything, it's a great lesson learned. So what did I do? I doubled down on the thought leadership. I started really talking about it. I started a local meetup and a networking event. And really started just intentionally reaching out to just tell people what I was doing and talk about the process and get people warmed up to the idea. Because what I found was a lot of people are just, I call it kind of like perceived risk through ignorance. And it's because people are not familiar with investing in real estate, right? For the most part. And if they are, it's probably like me, where they know somebody that's like their own landlord, and those people just bitch and complain all the time about their tenants and the toilets and the termites and stuff, right? So it's like never a good experience. And so that's people's perception. So you have to explain to them, one, like the benefit, like before you start talking about your deal. What I found was, I need to convince people that they should be investing in real estate. And then I need to convince them they should be investing in multifamily real estate. Then I need to convince them that they need to invest in multifamily real estate with me. And only then can I tell them about the deal. Right. So it's a process that you have to go through to get people to the point where, and many times they can kind of get out of their own way because they just aren't familiar with the process. And like, to me, when I heard about like real estate syndication, especially, like it was like a light bulb went off in my head. I considered myself a pretty savvy investor. I was an active stock investor. I mean, I was a finance major in college. I focused on investing, but I had never heard about this type of investment. So when this light bulb went off, I'm like, oh my God, you can get cash flow and you can get appreciation and you get tax savings, you get all these things like that. That was why I was like, man, I'm going to dedicate the rest of my life to just doing these deals and building wealth in this way. Right. But not everybody kind of has the same maybe risk tolerance or the same drive to go and do that. Right. So you got to kind of help people along. You got to help them along and explain the process and explain the benefits and the relative safety and if you can do that well, then I think you'll have plenty of people that want to invest. What I've found now is it's not about selling to people. Like nobody wants to be sold to. Really what I try to do is I try to educate. And what I found is if I can educate in the right way and remove the barriers of their own limiting beliefs, then just like me, it becomes a no-brainer. It's like, wow, yes, of course I should be doing this.
Yeah, no, I sound like you, you sound like me. Like that's exactly like everything you said. It's like, especially the equity piece, like people reach out to me all the time and they say, oh, I can raise $1 million. I'm like, you don't know yet until you know. And sometimes until you know might be too late.
You don't know until you've done it. Yeah. I mean, it's harder than people think. It really is. And like, because, and even like I've had people that I've like potentially like almost partnered with that have said, hey man, I can come in, I can raise all this money. And then like we do a little test run and it's like, oh man, this is a lot harder. It's like, cause like people that may have like a good Rolodex of high net worth people from maybe another business. But again, it's like, and what I explained to them is like, they don't view you as a real estate expert. They don't view you as someone they're going to hand 50 grand to go take their money. They view you as someone who does X service for them. Right. And that's a very different thing. So you've got to change that perception.
Yeah. I love it. Kent, I wish I can just keep talking to you, but we're definitely dwelling into the quick round. So these are going to be quick.
Right on, man.
Yeah. Quick. You ready, sir?
I'm ready.
All right. First question. What makes you, Kent, unique? What is that differentiating factor that separates you from the next guy or from the next guy?
Yeah, that's a great question. And I didn't know what that was for a long time, but I have received the same compliment a few times in my life. And what that is that I'm very good at taking complex topics and making them very simple to understand. And I think that's my superpower, right? I think that's what allows me to, like we were talking about, help remove those barriers for people, right? Remove those limiting beliefs, because if you truly understand something, then you can explain it very simply, right? If you don't truly understand something, that's when, and like I was a consultant. So like consultants are like masters of this, right? You just talk in circles and you use a bunch of jargon. And you do that because you probably don't really know it, right? So if you can boil it down to be really simple, I think that shows true mastery.
I love it. Second question. What was the last book that you read? What was the one thing that you picked up from that book?
Yeah, well, I'll tell you about a book that I'm currently reading, and it's called Think Again by Adam Grant, and it's all about this idea that like your beliefs are not permanent, and they're not like core to who you are. Your beliefs are largely things that are formed in your formative years, right? When you're growing up and from your parents and teachers and friends and things, right? Like for me, that was 30 plus years ago. It's like, so should my beliefs still be the same as they were 30 years ago? They shouldn't, because I've learned a lot since then, right? Your beliefs should change as you continue to learn new information. I just think that's a great message for like the world we're in now, where people have drawn, walls, lines, and things that kind of be divisive and separate us. It's like your beliefs should change. You shouldn't hold on to them just because you feel that it's core to who you are, right? They should be more fluid than that. And like the last thing I'll say is there's this awesome quote in the book from Ray Dalio, and it's like if you can't look back every year and say, man, I was really stupid last year, then you didn't learn very much in the past year.
Yeah. And Ray Dalio is a legend. His book Principles is just, I definitely have to. Awesome. I'm adding the Think Again book to my Amazon cart right now. Yeah, it's a bestseller on Amazon. So thanks for sharing that. Last question. You're busy. You've got your deals going on. You've got family, obviously. So what do you do for fun?
Man, I'm trying to learn how to play golf.
You and me both. You and me both.
Yeah, right. And it's something I picked up later in life. Like I grew up very, very blue collar. We were comfortable, but we were definitely kind of lower middle class, right? Like we didn't golf on the weekends, right? That wasn't something that we did. So it's something that now I'm getting too old to play basketball, man. Too many of my friends are going down with like ACL tears and Achilles tears and all this. It's like, we're too old to be out there still trying to jump around. So, so I'm trying to learn golf.
I love it. I love it. I love it. Well, Kent, this is awesome. If somebody's listening and thinking, I want to reach out to Kent, get connected with him, what's the best way people can reach out and get to know you better?
Yeah, I mean, there's a couple ways. One is my website, kentritter.com. It's my name, really easy. That's my home base. You can access my podcast and my blog, and I've got some passive investor resources there for folks and a couple freebie documents people can pick up, really all focused on multifamily investing. The next I would say is I'd love it if people would listen to my podcast. It's Ritter on Real Estate. And we talk a lot about how to make good investing decisions and what are things that you need to understand to be a savvy investor. And last but not least is social media. I'm really active on LinkedIn and Instagram. I'm on Facebook too, a little less active, but you can find me anywhere and reach out and I'd be happy to talk.
Kent, you're a legend. Appreciate you. Thank you. Thank you. Thank you.
Oh, I've had a blast, man. It's been awesome catching up.